Good morning, everyone, and welcome, and thanks for joining this MST Financial NWR Communications webinar. Apologies, but a bit of a plug first. I am your host, Aidan Bradley from NWR Communications. NWR was founded way back in 2007 and is an investor, communications, and media relations firm specializing only in the small to mid-cap ASX listed company space. It has offices across Melbourne, Sydney, Brisbane, and Perth, and its experienced team of over 25 now provides that full spectrum of IR, media, and comms services to our clients. MST Financial, who we all know, is a leading research and broking house offering the full spectrum of institutional brokerage services. They have a dual research platform with two specialist divisions, MST Marquee and MST Access, each of which have their own highly experienced and probably competitive market professionals. MST Access is a company-sponsored research platform which has been delivering institutional-grade research for over 7 years and currently covers approximately 100 plus small and micro-cap companies. It aims to deliver consistent, high-quality research for emerging growth companies, helping them reach a wide investor audience, strengthen the share register, and unlock value over time. So that's it. Now on to the good stuff. The title of the webinar today is New Technologies, New Frontiers, the Next Generation of ASX Oil and Gas Winners. We've brought together a strong group of ASX-listed oil and gas companies that collectively span the full spectrum of the sector, from frontier exploration and appraisal through to development, production, and even a couple providing capital returns. You'll hear today from these 7 companies who are already differentiating themselves. Their median share price performance over the past 12 months was a positive 22.5%. And this compares to Brent crude that was down 10%. So no tailwinds there, and just an average 3% return from the big 5 oil and gas companies on the ASX. This Magnificent 7, which unfortunately doesn't include Yul Brynner, but does include some of the hottest gas stories over east and in the Northern Territory, developing new crucial gas resources in the Beetaloo and Amadeus basins and the Taroom Trough. Today also includes the operator of the last great undeveloped gas resource over here in the west, and the best performing ASX oil and gas story of the last 12 months, a 15 bagger if you had been in it. This one showing that exploration and appraisal can create value for investors if the operator knows what they're doing. And additionally, we have 2 producing companies with different strategies, but generating real positive cash flow and returning capital to shareholders in their own different ways. But before all of that, up first, we have highly rated MST Financial Oil and Gas Analyst Saul Kavonic, who will provide an overview of the current market in oil and gas and set the scene for the rest of the day. Saul is the Senior Energy Analyst at MST Financial. He's now over 15 years experience in the sector, although that's probably a statute of limitation. I think it's a bit more than that now, Saul. And prior to joining MST in 2024, he was the head of energy and resources equity research at Credit Suisse. Over to you, Saul.
Thank you. I've been tasked with the impossible of covering everything from oil and gas, macro, geopolitics, down to domestic gas policy and opportunities in 6 minutes. So here we go. I think it is worth touching on the macro. We've seen many forecasts over the last year, a very pessimistic outlook for oil, and yet oil still continues to hold up in the 60s. A lot of that's being driven most recently by geopolitics. We had the disruption from Venezuela, which has come back, then Kazakhstan due to Ukrainian attacks on Russian infrastructure, which has come back, and now the potential for some kinetic action on Iran. But something that's missed is overall the balances still remain rather tight according to the forward curve. We've not seen an incentive to put barrels into storage. And there's every reason to believe that all the forecast underlying demand numbers have been too low now for some time. Also, we think we should touch on the LNG outlook, where again, no shortage of pessimistic forecasts, but I think we need to have some context here. Right now, there's a consensus view that LNG is going to face the greatest period of oversupply that it's ever experienced in 2027 and 2028, which could see prices drop to about $7 an MMBTU on annual average. It's worth bearing in mind that only 5 years ago, $7 an MMBTU was the mid-case consensus forecast for LNG. It is now considered the worst case scenario floor price. And what does that actually mean for mid-case LNG prices going forward? Consensus is currently at $9, but there's every reason to believe that LNG prices could be in the 10 to 13 range going forward, if for no other reason than the significant cost inflation we've seen in the sector. That's particularly important when we look at some of the companies who are going to speak after me. Those who are in exploration phase or earlier in development phase, where a lot of volumes are only going to be arriving materially later this decade, that long-term outlook and that potential for much more bullish long-term prices is quite supportive and very important. The last and perhaps most important macro theme, which comes back down to Australia, is peak ESG is now officially behind us. That happened in 2025. And appetite to invest in exploration has returned again. Just 12 months ago, it was still exceedingly difficult to get money into this sector. That has changed over the course of 2025. In Australia, we have seen since the election, Labor has certainly internally moved to a more pragmatic path. They're still working out how to verbalise some of that. But if you look at, for example, the appointment of Murray Watt replacing Tanya Plibersek as Environment Minister, when you put a Queenslander in replacing Tanya, who was basically, completely beholden to inner city green politics, I think that's a sign of where Labor's going. They're still, far from what the industry would desire, but there's certainly a swing back from the extremes more to a more pragmatic path. And that leads us to some policy changes underway, including the gas reservation policy here on the East Coast. Now, there's two ways that this could play out. One is Chris Bowen could actually implement a very good, sensible reservation policy that could put downward pressure on prices over the course of the next several years, but it's likely to put upward pressure on domestic prices from 2030 onwards, given the implications it would have for the export industry and bringing those LNG projects into decline. The other path is that Chris Bowen completely stuffs up the reservation policy, as Labor's managed to stuff up every gas policy they've implemented since they came into office in 2022. Now, if you're in that, if you believe that's more likely, then we're going to see persistent high prices, and actually the policy interventions only make the supply-demand outlook tighter and better, particularly for those smaller domestic players who are looking to tap into that market. East Coast gas prices, therefore, are looking to remain supportive pretty much come what may from the 2030s, and some uncertainty in the very near term, depending on how policy development plays out. There's a lot of different companies and plays looking to tap into this. I would like to just highlight for a moment the Taroom Trough. I think Trevor from Amiga might be speaking after me. Probably one of the most exciting plays to watch this year. There's a reason that you see very experienced, long-standing investors in Australian exploration like Shell, TriStar, and now Beach, as of yesterday, entering this play. It's one of the few plays with large, scalable, long-life potential, both liquids and gas, which is right near infrastructure, and in Queensland in a pro-development jurisdiction, unlike here in the People's Republic of Victoria. Also worth just touching very briefly, West Coast market dynamics also remain quite supportive. We've seen domestic price markers move around, very low last decade, spikes into almost double digits over the last couple of years, have come down again. But because there's no big new LNG projects being built in WA after Scarborough, and Browse looks a way off if it happens at all, you're looking at quite a supportive market there for gas. You're also looking at quite a supportive market for power. People, in Australia on the East Coast, we tend to focus so much on the crazy dynamics and policy going on the East Coast. But West Coast, even though it's a lot more sensible and pragmatic from a policy perspective, still has fundamentals to deal with in terms of rocks and capacity in its power market. And that is looking to remain increasingly volatile and elevated not just over the near term, but over the longer term as well. I think all of these things actually suggest a relatively supportive backdrop for investing in exploration and small players over the coming next few years, which is not something we could really have said over the 2020 to 2024 period. But the appetite to invest is back. And that's why I'm looking forward to hearing from all the small domestic companies who are bringing that appetite to bear over the next few years.
Thank you, Saul. Great run through, and I think you hit the objective of giving us a great understanding of the market in just 6 minutes. And hopefully each of the speakers today will touch on their own part of that. Hopefully you can stick around and listen to them, and we can catch up later. The first company speaker today is Trevor Brown, who is the MD and CEO of Omega Oil and Gas. The ASX ticker there is OMA. OMA are targeting major oil and gas reserves in one of Australia's most promising energy frontiers, as Saul just outlined. Their key project is situated in Queensland's Taroom Trough, within the Bowen Basin, benefiting there from the proximity to infrastructure markets and also, from a regulatory standpoint within an established energy province. So over to you, Trevor.
Thank you very much. I believe you can see my screen. Is that correct? That's correct. Excellent. All right. Thank you. Thanks very much for the opportunity. With 8 minutes, I'll hit the highlights and get right to the nub of the situation. Saul's done a good job in outlining the macros. Fundamentally, from an Omega perspective, that's one of the last things I'm concerned about, because I believe he's right in saying peak ESG has passed and things will only improve as the reality of the lack of supply in both the domestic and the international market have an impact on the politics, and hopefully sensible policy making will come to bear. So the theme of the discussion today is about new technologies and new frontiers, and we're applying technology into a new frontier, existing technology into a new frontier, as is a common theme in some of these unconventional basins in Australia. We're riding on the back of all the development of the technology in the US and applying it to really prospective geologic basins in Australia. So at the very heart of it, if you go back over the history of oil and gas in Australia, the big conventional plays, Gippsland Basin, Northwest Shelf, and then more laterally, the CSG province in the Central Bowen Basin, have been the major, really large-scale developments. Now, the Gippsland Basin's decline has coincided with peak stupidity and all the policy settings that we've had over the last 10 years to disincentivise exploration. So there's a big gap in the supply of oil and gas that is needed in the market, and demand is going nowhere but north, and the advent of AI is only exacerbating that. So the problem here is not market. We understand demand, and it's really about the resource and defining the really large-scale resource. Conventional supplies are gone. We're now into unconventional space. Look around Australia where you can have serious volumes of oil and gas from unconventional basins in a time frame that's meaningful, and you come to the big two, which is the Beetaloo and the Taroom Trough. And so what we're doing is moving ahead as fast as we can in the firm conviction that in the argument between physics and politics, physics will win every time, and the demand for gas will only increase the longer the settings are, policy settings are disincentivising exploration. It'll only mean higher prices. So we're not worrying about market, we're worrying about resource. We've got a really clear focus on how we can really develop the resources in the Taroom Trough and understand what it needs to turn them from trapped in very tight, deeply buried rocks and produce them at commercial rates in serious volumes in as short as possible time frame. So Omega is a really well-funded small cap with some really serious resource investors behind us. We're very grateful to have an excellent register that should see us really progress through the ranks pretty quickly over the next few years. And they're patient. They're ready to invest in the capital that's needed to be able to move things forward at pace. So yesterday we announced we were awarded this new exploration licence from the Queensland Government, and we are delighted to be able to say that we've been given the vote of confidence by the government to be deemed the operator, and we've brought in a couple of new partnership arrangement, or a new partnership arrangement. So it's Omega 45% and operator, TriStar 30% and Beach 25%. So we brought Beach into the Taroom Trough for the first time, and that's a good validation point. Beach are a highly credible technical company, as are TriStar, an existing investor and big balance sheet. So we're well set up, and I think we've been given a good vote of confidence by both the industry and government that we actually know what we're doing, we know how to operate credibly. We're quickly developing into a reasonably large scale E&P company. As well as that, we've got a 19.43% interest in Elixir Energy, which hold all of the acreage that is stippled with the dots here. So we've got a really large spread of interest across the Taroom Trough now, and this year is going to be a major year of development in the Taroom Trough, with a lot of drilling, up to about 10 wells. One drilling right now at Laurel, and then Shell have a program that they'll be undertaking with the same rig, the H&P 648 rig, and then the rig will come to us in May, or late May scheduled, and we'll start a series of wells, vertical wells, to really delineate the scale and the quality and the distribution of the resource across our acreage area. And so by the end of this year, with all of that drilling and knowledge, the Taroom Trough will be re-rated, and I believe in a very positive direction. So let's talk about the technology and the frontier nature of this. This region has been recognised for a long time as hosting large volumes of oil and gas. The trouble is they're trapped in low permeability rocks, so what you need is extended reach horizontal wells and fracture stimulation to be able to get it to flow at commercial rates. That's the nub of the problem, and that's what we're really focused on. So we did that last year with Canyon 1H. We drilled a horizontal well. It was a proof of concept well, 650 metre horizontal, and then fracture stimulated it and tested it, and it flowed really good rates of both oil and gas. A really light oil, 49.5 API, and high levels of condensate and gas. So really attractive resource base, less than 1% CO2. It's a really nice geologic province from its fundamentals. And the trick is really understanding the technology, the mechanical aspects, the geomechanical aspects of it, understanding the stress regime, understanding where and how you place your horizontal wells, in which zones and in which direction, and then how you design your fracture stimulation program to be able to get those rocks to flow at commercial rates. So you can probably see from this simple diagram of a seismic line. I'm not going to show you the line, but this seismic line here, it's about 45 or 50 kilometres long, and it extends through the Canyon 2 well, through the Canyon 1 well, and up through the Tasmania well, and then further up into this new block. The geology here is pretty layer cake, tram lines. The same features that apply here extend further into this block. And this is a non-geology version of why I'm so excited about this. This seismic line was acquired on a road because it's easy for the trucks to roll along the road and acquire the data. All three of these wells were drilled basically on well sites that were on the seismic line, which was on the road. It has nothing to do with the underlying geology. So we drilled 2 wells here 2 years ago and came up trumps with the testing of this one. This well was drilled, a vertical well, and tested in 2011, I believe. So either we got incredibly lucky that this road happened to correspond with the best geology in the area, or more likely, these resources are spread over a very wide area and the same geologic conditions apply over a very large area, because that's what the seismic is showing us. So this well, Canyon 1H, was a really important proof of concept well, that we could drill the wells horizontally, that we could identify the zones that have the potential, we could frack them, and when we fracked them, they flowed at really good rates of oil and gas. So that's why we're so excited about this next program. We'll be drilling a number of vertical wells, larger diameter vertical wells, getting the logs, and then looking at how the quality and distribution of the resources across the area, and then deciding where we do our horizontal wells, and we'll choose the areas that give us the most definitive data to recognise and understand where the sweet spots in the area are, and hence move into early development and production as quickly as we can. So it's an exciting time for the trough. We've also got access to, obviously, the interest we have in Elixir, the learnings and understandings that they'll be testing, this northern extension of the play that Shell have successfully explored and developed, and how those learnings apply to the rest of the basin. There's basically two provinces. There's the western flank that runs down this side and the eastern flank on this side. We're already really excited about the eastern flank, and we'll see what comes to pass in the western flank. So by the end of this year, we'll be in a really interesting position to be able to take things forward in a meaningful way. So just really quickly, I mentioned September 24, we drilled the first horizontal well into that eastern province. We then tested it around Christmas and were excited with the DFIT results. Then we had a successful frack in March 25. It all culminated in what I call a play opening well test of strong oil and gas flows that really unlocked the potential for a large, and I'm talking billion barrel plus province of beautiful quality, 49.5 API, light oil, and lots of really good gas with very low CO2s. This all came from one layer, and there are multiple layers broadly in 5 major levels in this beautiful stacked Permian overpressured sequence. The modelling shows that we can produce a 10-year EUR of about 0.95 million barrels of oil equivalent. In this particular layer, that was about 2/3 oil, 1/3 gas. This is where we sit now with our big 26-27 program. This is a little out of date because as of yesterday, we've expanded that. We're going to drill 4 wells, 2 in that northern block, and then we'll have another string of options that we can use for the horizontal sections. So really exciting time. At the heart of everything, as I say, I go back to the fact that it's about the physics, it's about understanding the rocks, it's about understanding the design of the frac, the application, the azimuth, the mechanical earth models. This is a deeply technical industry in terms of just being able to drill the wells down to 3,500 metres and then go lateral for between 1,000 and 3,000. Ultimately, that's where we think we'll end up with our development wells. So this is what it's done to the US, the unconventional, when they applied this technology to these good basins. We think the Taroom Trough has similar characteristics to some of these really prolific basins, such as the Permian. And in fact, I'm off there next week for a 3-week visit. We're going out to the field to look at some of this technology, talk to the contractors and see how we can apply them in the future. So I'll leave it at that. This technology and this resource is really attractive, and I think we're in for a very, very exciting year ahead of us.
Thank you, Trevor. A great run through, just conscious of time. So if anyone has any follow-up questions, you can either hit us up here at NWR, Trevor directly, or MST Access. So thank you, Trevor, and look forward to hearing about your trip to the Permian. Always good to get over there.
Thank you.
Up next, we have Will Barker, who is the MD of Equus Energy. Ticker there is EQU. So we're moving from one huge resource over east to a massive resource here in the west. Equus, as we know, are operator of a large-scale discovered and already appraised resource on the Northwest Shelf, probably the last one independently held. So positioning it to supply a vital new source of gas into WA's domestic market and the LNG plants that are going short. The market is hearing you, Will. You're up 60-70% since listing, so looking forward to your run through of the story.
Thanks a lot, Aidan. Great to be here and appreciate everyone making the time to listen in. Here to present a different story to most rather than exploration. What we're putting forward is an opportunity to develop a proven gas resource sitting on the heart of the Australian LNG industry on the Northwest Shelf. It was great to hear Saul talk about not only the East Coast. We obviously hear a lot about the East Coast gas market, whether it's in the press or in politics, but the WA gas market, it was an extremely large market, very large LNG exporter, very large domestic market for mineral processing in particular. And as Saul pointed out, we haven't had investment in new LNG projects, which traditionally have delivered a lot of the domestic gas supply. We haven't had new offshore exploration for a number of years, targeting expansion of these projects. And beyond Scarborough, we've got the pipe dream of Browse. But what that means is we've got an undersupplied domestic market, and we have a large amount of LNG infrastructure desperately needing new feedstock for LNG exports. So Equus Energy listed late last year, mid-December. It was great to be able to get the support of your major investors. We raised $15 million at 20 cents and are now sitting at around a 40-cent share price. We believe we've got a long way to run as we go and expand awareness of the story and deliver major milestones. The Equus resource, as mentioned, sits on the Northwest Shelf. We're between the mega projects at Gorgon, Wheatstone, Pluto, and the latest development, Scarborough by Woodside, which is being developed to backfill the Pluto and expand the Pluto facility. We're the 100% owner of the Equus assets. It has a certified, fully appraised resource base of 1.7 TCF and 38 million barrels of condensate. So over 320 million barrels of oil equivalent. And there's been over 1.5 billion US invested in the project to date. We were fortunate enough to acquire it off big American company Hess that spent that capital on exploration, appraisal drilling, did an amazing technical piece of work exploring the area, had great success with 15 discoveries out of 17 wells. They ran into financial trouble post the crash of the oil price in 2015, and we were fortunate enough to pick up the asset. What we've now done is take what was traditionally a stranded asset and we've connected it with market. So we now have heads of agreement for processing of the gas through the LNG facilities via the Pluto connection into the Pluto platform, the Pluto pipeline, which then connects us into both the Pluto LNG plant and the Karratha LNG plant. So what will be over 25 million tonnes of LNG export capacity. We also have a separate agreement with Santos for connection into Varanus Island, which will enable us to connect into their 450 TJs a day of processing capacity on Varanus Island. So we have an ability to be a capital light tieback development, leveraging existing both offshore and onshore infrastructure to connect us in to that very large both LNG and domestic market base. To help us do that, we had a great milestone in September last year when we brought in Australia's largest gas buyer, WA's largest gas buyer in Alcoa. Alcoa have committed $30 million US, around that 45 million Aussie mark, to enable us to undertake our FEED studies and advance the project towards a final investment decision. Brilliant to have them as a blue chip customer in there supporting us financially. They need the gas, they need long-term gas, and they saw the need to facilitate the projects like Equus to bring new supply in and provide them with exclusivity over those volumes. We have a range of near-term catalysts with the utilisation of that funding to undertake our pre-FEED studies, which we commenced in October last year. That will lead into a formal partnering process where we, sitting there at 100% ownership of the last major multi-TCF resource base on the Northwest Shelf, have route to market, have funding, have that market demand, and in the position now with the financial strength from Alcoa and from our listing to be in a great position to bring in project partners, operators, infrastructure players that help us monetize that very large resource base. Touching on the Alcoa transaction, as I mentioned, it's 30 million US of funding, which provides them with exclusivity over our domestic gas volumes. So we saw this as a great way to get strong financial backing on a commitment that we need to make, we have made to the WA government to provide that 15% of our volumes into the WA domestic market. While it's 15% of the volumes, when you look at it from a revenue point of view, it's around 6% of our revenue when you include the condensate and LNG offtake. So it was a great way for us to secure that last phase of funding towards a final investment decision and provide Alcoa with exclusivity over those domestic volumes. It's not a debt facility. It's not even a prepayment. It's an option fee that they are paying to secure the gas volumes at a long-term rate at a discount to the future market, but provides us with the important factor that we keep our highly attractive LNG volumes up to 2 million tonnes per annum and our condensate to market to the major international partners and off-takers to get the financing and partners for the upstream development. That LNG market is huge. Your WA on this stretch of coast between Karratha and Onslow accounts for 50 million tonnes of LNG export. 12.5% of the entire global supply, around $36 billion a year in annual exports. So it's a big beast and it's very hungry. And after 30 years of production, it's consumed virtually all the resources in the basin. The Karratha gas plant, the traditional big producer, 17 million tonnes of processing capacity, had to shut in their first train last year, and they are in steep decline, effectively out of gas by the early 2030s and sitting there with up to 17 million tonnes of capacity underutilised, and the dream to bring Browse into it. That's where we also have then the Pluto plant that needs gas as well. Needs over 2 million tonnes per annum of rich gas like Equus to be able to keep that facility full. So we're working with those partners to utilise that capacity, enable a capital light development back into existing infrastructure. Quick market comps, we're trading now at around that 35 to 40 cent range. Puts us at a valuation of around, with our large resource base of over 320 million barrels, around that 24 cents mark a barrel. So we compare very favourably to a number of our peers on this call today. Groups like Finder, who have had a great run, hit important milestones, taking them from a stranded resource to one that's now well and truly on the way to development. That's what we see in front of us. That ability to work like our other discovered undeveloped peers, like Conrad as well, that are in that $2 to $3 to $4+ a barrel mark. So that's our aim. Get out there, spread the story of Equus Energy, be able to hit major project milestones and unlock that value for shareholders.
Thank you, Will. Great run through and good timing as well. So we have about a minute for questions. You outlined there at the end that large resource that you have and the current valuation of it. What are the, for investors that may not have seen a junior with this scale of resource before move through to de-risking it, what are the key milestones and hurdles that you have to pass through in the next sort of 12 months to re-rate that resource valuation?
Here's a slide I prepared earlier, Aidan. So if you can see this, the major milestones we're working through, we've secured our financing, we've secured our domestic offtake, we've kicked off our feasibility studies. So those feasibility studies will be wrapped up in Q2 this year, enabling us to advance then into our partnering process mid-year. You're in that really fortunate position where we have 100% ownership of an asset on the Northwest Shelf, surrounded by the majors, with a fully appraised, development-ready asset that can backfill and connect into existing infrastructure. So our process is, rather than we're not here with a whole series of drill bit news as we go exploring, that risk capital is being spent. Our big milestones are commercial milestones. So kicking off a partnering process in mid-year, that partnering will range across a number of facets of the business. You're from EPC type partnering, again, mentioning Finder, they did a great job bringing in Schlumberger as a partner to help them with feed and execution of development. Similar milestones ahead for us. Others around LNG processing, taking those non-binding agreements we have with the likes of Pluto joint venture, Northwest Shelf joint venture, and Santos through to a binding phase. We're also then working with your non-operating partners, the big traditional Japanese, Korean partners that we've seen acquire your large interest, your 25% interest in Scarborough right next door to us with your LNG Japan and JERA. And then there's been new entrants like the big investment funds like EIG buying Tokyo Gas out of Scarborough, GIP now owned by BlackRock that are funding the Pluto expansion, big infrastructure players like that want exposure to LNG. So they're the big commercial milestones ahead of us. They're the ones that take us from 10 cents, 20 cents a barrel equivalent into the dollars, multi-dollar range over the coming near term.
Thanks, Will. Look forward to you adding a lot more green to that chart as we go forward in the coming months. So thank you. And we're going to rapidly move on. We're going to move from our first two presenters with very large undeveloped resources to an actual producer. Up next, we have Damon Galvin, who is the CFO of Central Petroleum. CTP is the ticker there. Central, as we know, are a well-established oil and gas producer with a diverse portfolio of tenements across the NT and Queensland. And most importantly, I think they operate the largest onshore oil and gas fields in the NT, which is now also becoming a very hot topical province, again, due to gas shortages, which is a common thematic we'll see. So thank you, Damon.
Well, thank you. Thanks very much for the opportunity this morning to provide a bit of an update to those who might have missed some of the announcements we've had, I guess, over the festive season. We've announced several very strategic or significant strategic and commercial initiatives, which I think are going to be the catalyst for some potentially transformational events for us over the next 18 months. So I'll just let me just share the screen here with you. That one. Yeah, so I think I guess some of the main things we've done over the last couple of months, we're close to finalising these new gas sale agreements with Power and Water Corp in the Northern Territory. That's going to effectively guarantee reliable cash flows for us right through till 2034. And it's going to underwrite the drilling of up to 4 new wells at Mereenie and Palm Valley this year. We've also expanded for the first time into the Cooper and the Otway basins. So we're chasing relatively low-cost, highly prospective targets there that are close to existing infrastructure and markets. And we've also agreed a conditional, I guess, spin-off, if you like, of 2 of our subsalt exploration permits in the NT to a UK-listed entity to try and get some activity happening there as well. Corporately, we've also launched our maiden shareholder return. We've had a share buyback scheme underway through the back part of last year. And underlying all of that is our ongoing cash flows from our production in the Northern Territory. So we've booked about $10 million of revenue in the last quarter. But I think firstly I wanted to give a bit of an update on the Northern Territory gas market. It's one that's been undersupplied in recent times. For those who've seen some of our presentations before, you might be familiar with this chart. What we're trying to show there is the supply and the demand in the territory for the last 5 years. So the dotted line through the middle, that's the sort of the average demand for gas in the Northern Territory. It's about 70 terajoules per day. And then the other colours are the supply side of that from various suppliers. So when the aggregate of supply obviously is above that dotted line, then there's an oversupply in the Northern Territory, and the gas typically flows east along the Northern Gas Pipeline to eastern markets. If the domestic supply is underneath the dotted line, then it's had to be propped up more recently by gas from diverted LNG. So if either from the Bayu-Undan field through Darwin LNG, which is now closed, or the INPEX LNG. So historically, if you look at the far left, you can see that Central and the blue block of gas, which is ENI's Blacktip field, have been the suppliers to the Northern Territory. Obviously, the Blacktip field, as you can see, has declined fairly steadily over time. They've drilled a couple of wells along the way to temporarily boost production, but obviously that has now reduced to nothing. So in the meantime, other suppliers, alternate supplies have had to be brought in. You can see the orange block was from the Bayu-Undan field, which is now closed. The red from, obviously from the INPEX LNG plant. And then for a very short period of time, there's a little yellow spike there where for the first time the Northern Gas Pipeline was reversed and gas was actually flowed from east to west to keep the lights on in the Territory. So it's been, I guess, an interesting period of time in the Territory. Obviously, there's a lot of anticipation for Beetaloo gas to come online. That's obviously a little bit behind probably where it was originally planned to be, and there's some uncertainty around when that may come and and at what volume. So in the meantime, Central Petroleum is still carrying or producing at the moment about half of the NT's gas demand. And if new demand comes online, for example, Arafura's rare earth mine, we could see that shortfall sort of be exacerbated further. So it's, I guess, in that sort of uncertain market that we've been able to achieve what we consider a very good commercial outcome in terms of gas contracting. We're in the process of finalising a multi-year gas sale agreements with Northern Territory's Power and Water Corp. These are contracts that will guarantee that all of our expected gas production from our existing wells and from 4 new wells can be sold right through to 2034. So that's 8 years worth of gas effectively spoken for. To try and articulate what that means on the chart, I guess the blue blocks was our existing gas contracts. If you put that into context, last year we sold about 4.2 petajoules of gas. So we're already pretty well covered for the next 2 years with our existing contracts. And then we had some gas available from 2028. So what these new contracts, that's the orange hatched areas on the chart, effectively does, it will result in a significant increase in gas in the next couple of years. Firstly, mainly because of the 4 new wells that we're going to drill later this year. And we expect to have them online throughout the second half of the year. We've got contracts in play or almost finalised with drilling companies, etc. So we hope to be drilling by July. So we're looking at really a 50% jump in production, revenues and cash flow, obviously, next year. And then we've got the security of a guaranteed government offtake effectively through to 2034 for all of that production. So our contracted gas position is now increased by about 150%. And that long-term financial security in an uncertain market is a real game changer from where we've been in recent years, and really gives us now a very solid financial base to start looking at some other options, whether that be returns to shareholders or other growth prospects. Sorry, I'll just flick to the next one. So that brings me to our big strategic initiative, and that's our expansion into the Cooper and the Otway basins. So as you know, they're well known, they're proven basins that when you compare to the Mardy's Basin opportunities, they provide a relatively lower cost, more prospective, near-term, in particular, opportunities for growth, and they're very close, obviously, to existing infrastructure, and they've got direct access to those buoyant East Coast gas markets, which are sometimes difficult to access from our other fields in the Northern Territory. So we've joined ADZ, they're a low-cost operator. We've picked up a 20% interest in PEP 169 in the Otway, and 49% of various permits in the Cooper Basin. So in the Otway, so we're very excited about this Enterprise North prospect. It's only about 2.5 kilometres up dip from the producing Enterprise gas field. It's an amplitude supported prospect. It's in an area where other operators had very high success with those types of prospects. So we're targeting drilling within 12 months. ADZ will be drilling it as a production well, so that if it's successful, it can be very quickly connected. So it's very close to existing pipelines. We've got 3 processing facilities at Iona, Otway, and Athena nearby. So there's potentially 18 BCF of gas net to Centrals, which potentially worth $200 million of revenue at today's prices. So, if successful, it would approximately double what are our current production volumes, and potentially at higher margins when you consider that there's minimal wellhead infrastructure required. We've got nearby pipelines and processing plants and relatively low transport costs into a higher price Victorian market. And there's other prospects in that block as well. In the Cooper, again, up to 3 wells planned there for early next year probably. These are relatively underexplored areas due to the permits being suspended until last year. So we've got at least 17 prospects and leads that have been identified there, and ADZ are working to select 2 or 3 high priority targets that we can drill early next year. So again, very excited about those prospects, and again in a proven basin and very close to existing infrastructure. I think over the next 18 months we've got a lot on our plate. We haven't given up on our big Amadeus Basin subsalt targets. As I mentioned earlier, we've struck a deal to effectively spin 2 of those assets off to Georgina Energy. That's a small UK-listed helium explorer in exchange for a 25% stake in them. If they can secure the funding, then this could provide a pathway really to unlock what are potentially enormous helium, hydrogen, and hydrocarbon resources in the NT. And if that goes to plan, we intend probably to distribute those Georgina shares out to our shareholders as a distribution to release some value, which frankly doesn't appear to be reflected in our share price at present. So look, in summary, we've got a big pipeline of potential value-adding activity over the next 18 months. We're participating in up to 8 new wells. We've got those 4 lower risk development wells in our existing producing areas that should boost our production by 50% by next year. And then we've got the higher risk, higher impact exploration wells across the 3 basins, the Otway, the Cooper, and the Amadeus. We're targeting material new sort of gas, oil, and helium in those areas.
Damien, thanks for that run through, and the follow-up questions people may have, again, just send them through. So conscious of time, we will move on to our next company. We will have Damon Neaves, MD and CEO of Finder Energy. Ticker there is FDR. Anyone that's been invested in the stock in the last 12 months will know that ticker, probably on your registration plate of your car, because I think it's been the best performer on the ASX over the last year. As I describe it, an overnight success, 20 years in the making, because Finder was established back in 2004, has a track record privately as a proven oil and gas explorer, then listed on the ASX in 2022, and is currently developing an oil field offshore Timor-Leste. So thank you, Damon, for joining us today.
Thanks very much, Aidan. Great to see you too, and thank you for that introduction. Look, I don't have control of my screen, so apologies for that. I'm dialing into the webinar from my mobile phone in Singapore, but hopefully it will run smoothly. I see we don't have the correct slide on screen. I was hoping to start with a map. But look, to tell you about our project, we acquired a PSC offshore Timor-Leste about 15 months ago. And we acquired it from 2 majors, ENI and Impex, and it was a stranded asset. And what we've achieved over that period, that last 15 months, is significant de-risking events that's taken a stranded asset to a near-term production asset. We're now on a fast-track development timeline to achieve first oil by late 2027, so late next year. Now, thank you. The map's up. You can see here on screen we're located about if you look at the inset map in the bottom corner, we're located about 150 clicks off the south coast of Timor. You can see the northwest coast of Australia. So we're on the part of the northwest shelf, on the Australian shelf out there, but in exclusively Timor-Leste waters. The fields we're fast-tracking development of are those ones in the north of the block called Kudetasi and Jahal, combined 25 million barrels of oil. Now, these are fully de-risked from a subsurface point of view, from a resource point of view. We've actually got 5 well penetrations just in those 2 reservoirs alone. We've got cores, we've got logs, we've got flow tests indicating flow rates of above 20,000 barrels of oil per day per well. And we partnered with SLB, formerly Schlumberger, for a fast-track development of this asset. So there's an important strategic alliance there with SLB, who are the world's biggest oil field services group. They're a 50 billion market cap group, and they're the only group that are a one-shop stop that can take us all the way through the engineering work, manage the development drilling, the procurement and the installation of the subsea production system, all the way to first oil. So I think for a lot of people, partnering with SLB in this way has taken a lot of execution risk off the development project. Last year, we also completed a farm-in with our existing partner, actually, Timor Gap, which is the national oil company of Timor. They now hold 34% in the license, paying 50% of the development capex. So we now have half the development capex funded. Actually, I'm here in Singapore on a debt roadshow. It's being run by Baron Joey to secure the remaining piece of capex for Finder. Late last year, it was December, we acquired the Petroleum, which is an FPSO, which is the main component of the production system, and Finder now owns that 100%. And that was, I think, possibly the most important de-risking event for the project. I think if there was anyone out there wondering if the project's going ahead, well, we've now got a 700-foot ship with a production system on the top sides, 35,000 tons of steel on our balance sheet. We're fully committed to this development, and it's going to happen very quickly. In fact, through the accelerated FEED project with SLB, we're days away from completing FEED, which is the final design concept for that subsea production system and the development wells. So this is a project with enormous momentum now. We've got very important partners with Schlumberger and Timor Gap. And I think what's getting people behind this project, and ultimately why we're getting so much interest from the debt groups, is 2 things that really make this project special. Even though it's a relatively small field, 25 million barrels, this is very high quality reservoir. It's called the Laminaria Formation. And you can see on the map there some of the legacy fields. Just around the edge of the block, we've seen around 300 million barrels of oil produced. Fields like Laminaria, Corallina, Buffalo, Kitan. All of these fields produced from that Laminaria Formation and produced at very high, very strong flow rates. So I think Laminaria Corallina peaked at 180,000 barrels a day. But even the small fields, Kitan and Buffalo, produced at peak rates of around 45,000, 50,000 barrels a day. So we're actually facility constrained with the FPSO, but we'll be starting out at about 25,000 to 30,000 barrels a day. And Simon, if we can flick to the next slide with the production curves, I think this is really what gets us excited. You can see here, this is the production forecast from our reservoir engineers. You can see there on the x-axis, that's years. The y-axis on the left is your daily flow rates. You can see that what I was just talking about, that initial plateau at 25,000 barrels a day, and then a typical decline curve for an offshore field. But that blue line's the cumulative production, and this is the exciting bit. You can see within the first 2 years, we produced 15 million barrels of oil. Now, at $70 oil, that's over $1 billion in revenue. So this project generates a powerful cash flow stream, and unlocking that cash flow stream is our highest priority at Finder. So with that strategic alliance from SLB, we're looking to finish the FEED in the coming days, and that'll leave us well positioned to FID. Really, the only thing to happen between now and FID, targeting mid-year for FID, is securing this last piece of debt funding. As I say, we've appointed Barrenjoey to run that process with us. But we've already had a lot of interest from quite different sources of funding. It's a broad process now to bring it all together. We're talking to the off-takers, the commodity traders, your private equity groups, conventional banks, all of the above, to get the most attractive terms we can. Obviously, debt is a way to maximise shareholder value, and we see debt as an important part of this project moving forward, and we want to get it right. And so we've got the Barrenjoey team there advising us. Now, I just want to finish with what lies ahead over the next 6 months. If we could go to the next slide, please. And really, as Aidan mentioned in his opening remarks, we achieved a lot last year, and we're one of the best, perhaps the best performing energy stock on the ASX. But really, still a lot lies ahead, and these are all, I think, important catalysts, and they're all happening over the next 6 months. You can see 7 on screen there. We're in the market negotiating to secure a rig. We've got FEED coming in the next few days. We've been working on updated production forecasts with our reservoir engineers. We've had a resource upgrade last year with Risk and their independent reserves report. That's now flowing through to our production curves. And of course, the debt funding that I've mentioned. And then by mid-year, we achieve FID. And at that point, we book Kuditasi and Jahal as a 25 million barrel 2P reserve. The only thing, technically it's proven, the only thing standing between us and booking a 2P reserve is intention to develop, which is securing the funding. Naturally, I've focused on Kuditasi and Jahal because that's our immediate task, is to unlock that value and get those fields into production and generate that cash flow. But within this PSC, we have 2 other discoveries called Krill and Squilla. They're a similar size to Kuditasi and Jahal. So we've got a secondary development opportunity there that's at the appraisal stage. And then we've got a series of what I would call near-field high-impact opportunities. And each one of them, again, is as big as Kuditasi and Jahal. One of them, called Lanjara, is only 5 kilometres from where we'll be locating the FPSO between Kuditasi and Jahal. So we've got a lot of work to do beyond Kuditasi and Jahal. I say each one of those, if they're successful, would double the value of the project. And now that we have the infrastructure with the FPSO, these are very high margin barrels. And this area, it's called the Lammen Area High, has enjoyed a very high exploration success rate. The industry has drilled 34 wells for 17 discoveries. So that's a very high strike rate. It's 50%, which is well above industry averages, even in proven basins in other parts of the world. Very quick overview there, Aidan. Happy to take any questions.
Yeah, thank you, Damon. Obviously got a tiger by the tail there, as they say, but just very, very quickly, given the scale of this opportunity, how do you balance this now against your exploration model, which has been very successful in its own right in the past?
Look, Aidan, it's for us, we're really excited about unlocking those cash flows. That's our first and highest priority. We maintain our exploration portfolio in the UK and Australia. Obviously, some headwinds there, but that's very sort of expenditure light. That's an operated model, and we're paid by our partners. Some are, much larger groups like Equinor, to do that work. So it doesn't cost us much to hold those assets, and they're all sort of high impact farm out opportunities. So that's still running, but really we are 100% focused now on Timor-Leste, and it's what a great asset. I think as a junior, we're very lucky to step into an asset that's had 100 million already spent on it. Genuine risk capital, de-risking the subsurface, proving up all these resources, and we get to step into a near-term development opportunity like this. It's once in a career kind of opportunity, and that's what gets us excited.
Right, mate. It's been a great year, and sounds like there's a whole lot more to come. So look forward to hearing from you in the future. Thanks, Damon.
Yeah, my pleasure. Thank you.
So up next, we have Matt Boyall, CEO of Q Energy. Ticker there is CUE. Q are on the production side of the spectrum. They're an oil and gas producer, so diversified commodity, with a diversified mix of assets across Australia, Indonesia, and New Zealand. Q Energy are somewhat unique amongst energy companies on the ASX, probably resource companies on the ASX, in that they return a very attractive dividend, paying a yield of 14% in FY25. So looking forward to hearing from Matt how he achieves that.
Great. Thanks, Aidan. And now good afternoon to everyone on the webinar. Through the next 8 or so minutes, I'll take you through a fairly simple story of Q, based on our high quality portfolio, our near-term growth options, and our dividend payments. Okay, so this is published on the ASX. I'll be taking the high points. Encourage everyone to have a look at the presentation online. It continues to be an attractive investment. We have a portfolio of non-operated production assets, and FY25 revenue was $55 million, and we produced 600,000 barrels of oil equivalent. We continue with our strong balance sheets and have no debt. The growth options that we will talk about to attract your attention to, as Damon pointed out, we are partners with Central Petroleum, and we signed a letter of intent with the Northern Territory Power and Water Corp for long-term gas sales agreements, which will support the drilling of 4 wells in the second half of this year. We also have, in Indonesia, further development planning at the Mahato PSC. Over the last 2 years, we have returned $31.5 million to our shareholders in dividends, and during FY25, that was a dividend yield of 14%. Here is a diversified portfolio. We have 4 production assets only, 2 in Indonesia, where we produce oil and gas, 1 in Central Australia, where our operator is Central Petroleum, producing gas for the Northern Territory, and offshore oil production in Maari. A diverse portfolio by region and by asset really creates a stable base for our company revenue. We have a very simple strategy. We continue to want to maximize value from our existing assets. It's the lowest risk opportunity. Develop where you know. We have a dividend policy that aims to continue with attractive shareholder returns to our shareholders, and we continue pursuing growth, but in areas we know. We are looking at continued low risk growth. In FY25, some of the key numbers at 6 months ago now, but it's our latest reports. We had revenue of about $55 million, EBITDAX of 30, and we had a final dividend in FY25 of half a cent a share result. And during the period of FY25, we paid out $14 million in cash as dividends. We have no debt and finished the reported last quarter of a cash also of about $11 million. As you can see in the chart on the left, highlights the 4 dividend payments we've made over the last 2 years, and you can see a big change in the Q share price and trading volumes after that time, attracting new shareholders and keeping our value up. We traded between 11 and 12% over the last year or so, with a market capitalization of about $80 million. And if you have a look at the table on the right-hand side, very low valuation multiples. Our asset base, the diversity, the oil and gas, and our operating performance means that we maintain a fairly stable operating revenue. On the left-hand side there, the chart shows that over the last 3 years, we've been plus or minus $50 million annual revenue over the financial year. You know, take into account the changes in oil price. So our diversification, it really makes Q a stable performing company. And this is shown out by the production we've had over the last 4 financial years. 600,000 barrels of oil equivalent pretty steadily over the last 4 years. On the left-hand side there, a lot of it from Indonesia, most of it from oil, but of course a changing mix as we move into more growth in Australia and Northern Territory gas development. And so if we look into what's happening in this calendar year for us, we announced last year that we've signed a letter of intent with the Northern Territory Power and Water Corp for long-term gas sales agreements to 2034. As mentioned by Damon from Central, this also puts a very stable cash flow balance from these assets into Q, very predictable over the long term. To support this, we will be drilling 4 development wells in the second half of this calendar year. So preparation is already ongoing and well advanced. 2 wells in the Palm Valley field and 2 wells in Marini field are planned. And we will also, as part of the letter of intent, look at tying up the gas sales agreements with PwC very shortly and move everything on. Apart from the new developments, the fields, Marini, Palm Valley and Dingo, they continue to deliver reliable gas, and they have done so for some time. As Damon mentioned, these fields support 50% of the Northern Territory gas demand at the moment, and the predictability of that demand gives a stable cash flow from the contracts we have. So very, very good stable cash flow, which helps balance our diverse oil revenue from other assets. We also continue to believe there will be strong market demand for gas, both in the Northern Territory and the East Coast market, which will support potential further contracts and pricing. So as the quick summary, Q maintains a portfolio of production assets which support our dividend policy, which is established and published, and attractive valuations. We have diversity in our oil and gas production, both by region and by product, which leads to our strong cash flow generation, which has been shown over the last few years. The main growth phase for the calendar year will be drilling 4 wells in the Northern Territory, and we have the balance sheet strength to do that with currently no debt and high operating cash flows. We had attractive dividend yield last financial year and have returned a significant amount of cash to our shareholders over the last 24 months. And we have an ongoing published dividend policy to support that. Shown earlier on, we have still very modest valuation multiples at 11.5 cents a share, given the revenue we produce and the EBITDAX and profit that we report on. In a quick summary, investors, I encourage you to go to the Q website, ASX website, download this, look in detail, and feel free to contact the company with any more questions. Thank you.
Thanks, Matt. Bang on the 8 minutes, so well done on that. Obviously, investors in micro and small cap resources don't get to see attractive dividends like you pay a lot. How do you view your dividend payment policy, given there are variables you can't control, like oil pricing? So how do you, as a board and management team, balance all of that with continuing to pay an attractive dividend?
Yes, so Aidan, we have a policy where the aim is to deliver sustainable returns. Okay, now that we don't have the ability to set percentage returns, and as you mentioned, we will have to balance continually when considering dividends, future capital operating requirements to establish growth in the company, and considering the oil price. But our key aim is we have delivering sustainable returns. That's the key aim of the policy of dividends we have.
Thank you, Matt. Look forward to seeing particularly that Northern Territory story with you and Central develop in the coming year. Sounds like a very exciting opportunity.
Yeah, thanks, Aidan.
So up next, we have David Prentice, who's the Managing Director of Brookside Energy. Ticker is BRK. This is another producer returning capital to shareholders and proving that you can make it work onshore US through following a very clear focused strategy, just as we saw with Q. In the case of Brookside, to grow production, build scale, and again, uniquely return capital to shareholders. Their operations are in the world-class Anadarko Basin in Oklahoma, a part of the world and an opportunity David, I can vouch for, has loved for many, many years. So great to see it coming to fruition, David.
Yes, thanks, Aidan, a journeyman of the industry. Can everybody see the screen and get a thumbs up there?
Yep, we've got the disclaimer up there, but
perfect. Okay. Well, thanks for that intro, Aidan, and I'm going to whip through this pretty quickly because obviously it's 8 minutes, so just going to hit the high points. But essentially, we think this is a very rare, what we're calling a triple re-rating opportunity. We think it's being driven by us catching up to our US listed peers. As Aidan said, we operate in the US, although we're listed here in Australia. We also think that we've got the opportunity to significantly expand our scale with our Riverbend opportunity, which I'll talk about a little bit in the presentation today. And we also think there's the beginnings of a broader sector recovery. So we think those three things are fantastic catalysts for the business for 2026. The business itself is really execution-led, not exploration. So we're operating in a basin where there's enormous amount of data, and the business is debt-free, fully funded, and as Aidan said, we're already returning capital and feel like this New York Stock Exchange ADR listing that we're targeting for the first half of this year is going to be the first catalyst of that triple re-rating opportunity. So in terms of the basin, the Anadarko Super Basin, we're operating in an area called Swish, which is in the southern part of the basin. This is a data-rich environment. There's been over 500,000 wells drilled in the basin. More importantly, there's been 8,000 modern horizontal wells drilled in the last 10 or 15 years or so. And it's the depth of the data that drives the outcomes here. It's liquids rich and it's resilient across the cycles, providing an enormous opportunity to build a business that's cash flow positive and it can survive through the cycles. So in terms of our strategy, it's pretty simple: grow production, build scale, and return capital. Value is created here through repeatability and continuous improvement, and we see that every day in terms of innovation, in terms of the drilling and completion techniques, and we're able to take advantage of that sort of cutting edge stuff that happens in and around us as we're drilling and adopt those practices when it makes sense to do so. So in terms of that first catalyst, the valuation disconnect, you can see here, the sector has been trading at multi-year lows for a very long time. It's underinvested, but we feel like that's about to change. In terms of where we sit, you can see here that despite the execution over the last 4 or 5 years in terms of EBITDA generation, we're trading at a significant discount to our US listed peers. And there's a real opportunity here, we think, through this ADR listing to be able to tap in to investors who understand this basin, understand the fantastic operating metrics, and can see that huge opportunity for us to catch up to what is already depressed sort of multiples of many of our peers. So we feel like that's a fantastic opportunity. So in terms of our track record, I guess this is about execution. We've drilled 9 horizontal wells and brought them all online successfully under budget and ahead of schedule. The production outcomes have been nothing short of fantastic, and that's really been what's driving the cash flow and obviously has built up our net reserves in this Swish area, which is at 12.4 million barrels of oil equivalent that you can see there. So, a fantastic track record of execution. And again, taking a step back, looking at, we're in a basin where there is an enormous amount of data. We know what's going on from a subsurface perspective. We're able to just apply modern horizontal drilling and completion techniques to unlock that value. So in terms of where we're at, as I said, we're in the Swish play, which is arguably one of the hottest areas in the Anadarko Basin at the moment. I could talk for hours about how we came across this area, how we got in there first, and how we built up our leasing position. But the punchline is we're now completely surrounded by some of the most successful, well-funded E&P companies in the US who've also seen this opportunity. There's been, in terms of the production outcomes and the drilling and completion outcomes, you can see all those green lines on the map there. In 2018, when we first started leasing, there were no horizontal wells drilled in this area, and now you can see a large number of horizontal wells, and you can see our acreage position sitting there in the middle. So it's the success of those first 9 wells and us being able to bring them online, as I said, under budget and ahead of schedule, building up that reserve position has really been what's been fantastic outcome for shareholders and set us up for what we feel like is a very bright future. So just quickly touching on the reserves, 12.4 million barrels of oil equivalent in net reserves. About 60% of those are liquids, and they're all in DSUs which we operate. So it gives us about 19 PUDs that we can go ahead and develop in full field development. So that's kind of the runway, if you like, of operations moving forward now that we've finished that reserve definition drilling. In terms of the second catalyst, in terms of this concept of building scale, we've recently announced a new leasing initiative in what we're calling our Riverbend AOI, which is, again, really taking a step back to where we were in 2018, looking for these sort of unique pearls, if you like, within the basin, along the basin margin, areas that have been overlooked by some of the larger companies, building out our lease position, and then drilling a reserve definition well, and then moving forward. So it's really repeating the success that we had in Swish in that period from sort of 2018 onwards. And so this is super exciting for us. It's got the opportunity for us to materially increase our reserves and our footprint, and we feel like that's going to be an important catalyst for US investors as they look at the business. And so in terms of the capital allocation framework, this is really about sort of maintaining and optimizing production, particularly in the current pricing environment, making sure that when we do pull the trigger on development opportunities that we're comfortable that they're going to generate the kind of returns we're looking for, maintaining that balance sheet strength, so kind of making sure that when we do use our reserve-based lending facility, we've got good visibility on how we're going to get that paid down quickly, and then making sure that we've got the capacity to continue to execute our on-market share buybacks. We're currently in the process of doing one of those now. We did one in 2023, so good track record there in terms of that capital allocation framework. So in terms of tactical priorities for 2026, as I said, it's maintaining production. We've obviously got a keen eye on pricing, preserving that inventory we've built up inside Swish, building scale at Riverbend, and then moving forward with the buyback. So I guess there's quickly on the capital structure, very simple capital structure, just about 95 million shares on issue, market cap of 40 odd million, 12 million in cash at the end of the quarter, an undrawn $25 million US credit facility. So obviously the company's in great shape from a balance sheet and capital structure point of view. So yeah, I guess to wrap up, the business is fully funded. As I said, it's execution led, it's not exploration. We're trading at a deep discount to our US peers, and we think that there are very clear catalysts for those three things to kind of unfold over the course of 2026 and provide a significant boost to the company's valuation.
Thanks, David. Good to see many years of hard work in the basin starting to pay off in terms of those returns back to shareholders. While I have you, just very quickly, we can't avoid a comment on the political landscape over there and drill baby drill. How has that impacted, if at all, Brookside's business in the US in the last couple of years?
Yeah, so look, I think it's probably impacted sentiment more than it's impacted operations. I guess, we saw a flurry of positivity around, the re-election of the Trump administration, and we saw, kind of this, I guess, a really positive signalling around, clearing the path in terms of regulation and really kind of making it easier for the business to, for businesses to kind of execute, across the country. In terms of us, it hasn't had a huge impact. We operate on private land in Oklahoma, and so we don't have a lot of federal intervention in terms of the business on a day-to-day point of view. So there hasn't been a huge impact from that perspective. But generally positive, although it hasn't been positive for pricing.
Right. Thank you, David, and look forward to catching up in the future.
Thanks, Aidan.
So our final speaker today is Alex Underwood, who is the Managing Director of Beetaloo Energy. Ticker is BTL. A bit of a disclaimer. I used to work with Alex when we were bankers, but we saw the light and both got out of that industry some time ago. So it's been great to follow Alex's career at Empire and now Beetaloo. Has done a tremendous job. Beetaloo is now easily positioned as the leading ASX-listed pure NT hydrocarbon player focused on the McArthur Basin and its Beetaloo sub-basin, which, if you follow any energy news, has been one of the hottest areas, not just in Australia, but regionally and globally in the last number of years. So looking forward to this presentation to end our day.
Thank you very much for having me, and also appreciate MST hosting us today. I'm Alex Underwood, the CEO of Beetaloo Energy Australia. We're listed on the ASX. Australia's east coast is in a gas supply crisis. This is fundamentally not a good thing for Australia, particularly given that we have so many energy resources in our country. As Australia goes into an energy transition, the importance of gas is only growing by the day. And as we are seeing in certain states of Australia that are not so gas resource development friendly, we will need much more gas, not only to support renewables, but also to support a growing economy by providing plentiful energy. It's my view, and that of many others, that the Beetaloo Basin provides us that opportunity to provide affordable energy for Territorians, provide affordable energy and a growing economy for Australia's east coast, but also to provide further LNG export into Asia in years ahead through existing LNG export terminals in both Darwin and Gladstone. The Beetaloo Basin is an enormous basin. It's one of the largest shale gas deposits on Earth. It's what we call a stacked play. So there are 4 very thick and highly contiguous shale layers that extend across hundreds of kilometres through the heart of the Northern Territory. It has world-class geological characteristics and is often compared to the Marcellus Shale, which was the driving force in providing the United States with the most affordable energy in the world and energy independence. And the basin itself, after a long time of talk of potential, will be moving into pilot production this year from both our company and our Carpentaria gas project, and also Tamboran Resources Shenandoah project. We are connected into the Australia's east coast through the Northern Gas Pipeline. APA Group has very well publicised plans to build a much larger pipeline to connect us at scale into the east coast. And we are only a few hundred kilometres away from Darwin, already a major LNG export hub. And on that note, I noticed that Santos had just delivered their first LNG cargo from the Barossa project, which is processed in Darwin, an incredible achievement for them. So just a quick overview of the scale of the opportunity. So first of all, our total acreage position numbers tens of millions of acres, but within the Beetaloo itself, we have over 3 million net effective acres. Netherlands Sewell & Associates, the gold standard in resource certification globally, has assessed us as having 46 trillion cubic feet of recoverable prospective resources. That is largely limited by well control, so the number of wells that have been drilled. And with our very limited drilling to date, we have already booked a 2C contingent or discovered resource of 1.6 trillion cubic feet of gas, a number that we expect to grow materially over the years as we continue to develop this resource. Our focus as a company is on moving into a pilot production project, the Carpentaria pilot project, which I'll step you through, where the driving force is to demonstrate the commercial viability of this play. There are lots of international players around the world, particularly with a shale gas DNA out of the US, who are watching this basin very closely. And as we and our neighbours demonstrate its commercial viability, I foresee an opportunity for an economic development in the territory that would certainly rival the Northwest Shelf project and potentially some of our biggest mining projects in Australian history. So our focus, as I mentioned, is on the Carpentaria pilot project. We are very fortunate that in our EP 187 tenement, located on the eastern side of the basin, we have a pipeline that runs right through our tenement, which will be about 500 metres away from where our gas plant is being constructed. That pipeline is owned by the Northern Territory government, which needs more gas supply urgently. We have signed a 10-year gas sales agreement with the Northern Territory government at a fixed price with a CPI escalator. While that price is confidential, it's a price that we are very happy with. We have drilled 5 wells in that block, 2 verticals, 3 fracked horizontals, including our most recent well, Carpentaria 5H, the largest fracture stimulation job in Australian history. We pumped 67 frack stages, 500,000 barrels of fluid and over 10,000 tonnes of sand into that well. We have carried out some flow testing, with more flow testing to commence shortly as the wet season comes to an end in the territory. And critically, we have started building the Carpentaria gas plant. We were very fortunate to buy a plant from AGL, the old Camden gas plant, for those who remember the Sydney gas story. It's in very good condition. It's undergoing some refurb work in Roma in Queensland, and we'll be sending it up to site soon. The focus for now is that pilot project, demonstrating commercial viability, moving into production later this year with the Carpentaria 2H, 3H and 5H wells, installing the gas plant and getting gas production going by the end of this year. It's actually been a long time since a new basin started producing gas in Australia. I think it was about 20 years ago in Queensland in the coal seam methane boom. And so we are very excited to be playing an important role in opening up a new basin. For those of you who remember the coal seam methane experience, while the geology is different, this truly has the same opportunity for scale as coal seam methane. Enormous gas resources in place, world-class geology and strong demand into both the domestic market and LNG export. While our focus is on the pilot project presently, once we get up and running, we see the opportunity to deliver at least 200 terajoules a day into Australia's east coast. Ultimately, I do believe that this will be an LNG export story given the scale of the resource, and we see ample opportunity to fill at least an LNG train, if not more. The size of this resource will never be our constraining factor. It will be based on demand for the market, which we only see growing in years ahead. Critically, we have unbelievable support from the Northern Territory government. There is bipartisan support in the Territory. A very robust regulatory regime has been put in place, and the NT sees this basin as having the opportunity to generate sufficient royalties to move, to give them independence from Canberra and also provide further economic growth. The resource positions we have are enormous. You can see here on this slide a comparison of our blocks in the red to the entire Marcellus Shale, which covers 5 states in America. The quality of our gas is a very high quality gas. There's no H2S, very low CO2, and also it's quite a rich but pipeline spec gas given the presence of ethane. There is a lot of activity happening in the basin. We've seen major US services providers enter the basin: Halliburton, Liberty Energy, Helmerich and Payne, Tamboran's drilling, Santos is going to start drilling again. The basin is really starting to move. And as I mentioned, the focus now is getting it into production. We've done the civil construction on the gas plant. We'll be moving it up to site in April. And once we finish the construction phase, we can expect to commence pilot sales either late this year or early next. So I might just pause there, and if you've got any questions, I'd be very happy to answer them.
Thanks, Alex. Obviously, another overnight success that took many, many years to get here. But, in this new reality of energy needs, how supportive has the Northern Territory government been in all of this?
Yeah, I mean, as I mentioned, their support's been unbelievable. So in 2016, NT Labor won the election, and there was community concern about fracking. Most places in the world have that have that situation have banned fracking. The Territory didn't do that. They held an independent scientific inquiry that found that it could be done safely with a proper regulatory regime. That regime was put in place. The Country Liberal Party came into power about 18 months ago, and they are focused on fast-track approvals, fast-tracking the development of the basin, supporting the entry of services players into the basin, and as you can see from our gas sales agreement, also supporting local energy supply out of the Territory. So incredible support.
Brilliant. Well done, the NT. Thanks, Alex, for finishing off the presentations today, and thanks everyone that has joined the call. I think we can all agree what we've heard today is a really strong overview of the ASX oil and gas landscape right now. In my view, the most positive it's been in a very, very long time. We've heard from companies unlocking frontier gas in the Beetaloo and the Taroom, companies focusing on near-term development, and even those now generating strong cash flow and returns to shareholders. I think across the presentations, the common themes are clear. I've just been jotting them down. Hopefully, fingers crossed, ESG has peaked. The reality of the scale of the future energy challenge may have finally got through to government regulators and investors. So there seems to be a growing number of opportunities in traditional oil and gas with prospects for junior players better than seen in a long time. Some great stories today. But there's still a need, obviously, for strict capital discipline and allocation, and to align projects with real tangible demand and meet both current and future market requirements. So as I said, thankfully, we may have entered the era of energy reality over dogma. We can only hope. So thank you to all the presenters and to everyone who joined us today.